Welcome back to another week, another episode of the Educated Home Buyer Live. This is where Josh and I answer your mortgage, your real estate questions right here on the air to help you become the educated home buyer. So, Josh, since last week, since last week, we actually had a big change, right? Thursday and Friday of last week were big changes in the market that actually helped interest rates in many ways. Since that, we haven't really had a lot of data this week, but rates are continuing to trend lower. Hence the name of the episode, that lower interest rates will eventually help the housing market. So that said, Josh, let's talk a little bit about Thursday and Friday of last week, and then we can dive into some charts.
Well, we had the big move on Wednesday when we did the last live. Thursday didn't give any of it back, which is a positive when you have a big move like that. Just not giving back the next day is a good thing. Then another big move on Friday. And then what we've seen so far this week, Jeb, we're not really all that much better than where we were on Friday, but not giving back is a very good thing. We talked about last week, after you got that big move, you don't necessarily have to lock if you're in the market and floating, but be ready to if there's any weakness. Because when we get these big moves, there's generally a little consolidation, a little give back before the trend keeps moving in that direction. And bigger picture, Jeb, we haven't even seen, after 5, 6, 7, 8, 10 days of good positive movement, you'd like to say that's a trend change.
Yeah.
But if you zoom out, we're still in a bearish market.
Yeah.
We believe there's a really good chance that it's turned, but we need a lot more confirmation. So it'll be interesting between here and the end of the year. You preemptively shaved your beard, but who knows? Maybe you will end up having been right and got rates in the sixes before the end of the year.
The beard was for a fresh start for many reasons on many different levels, and primarily for what happened in my family. We just needed to start over. So that said, I wanted to keep the beard going. I thought it was going to be a New Year's beard, so to speak, but I'm glad to see it go, if I'm being honest. All right, so let's start, as we always do, take a look at some charts here, Josh, and then we will start answering your questions. So if you're watching now, and you haven't, we're not getting a liquid death sponsor.
I'm going to hold this until we get the sponsorship. So you keep going. I'm just going to hold it right here for the show.
That guy sold that thing to Coca-Cola for like $1 bajillion. Anyway, if you have questions, start putting them in the chat now. That way, when we're done, talking about the economy, talking about the Fed, inflation, recession, all of that good stuff, the questions will be there, and we can just kind of jump into them and get this thing moving. So we always start with inventory. Once again, they've changed the chart that we've used week over week. But this more or less shows inventory sitting at 566,000 homes, which is getting us really, really close to passing over where we were last year. Now, nothing really to talk about there other than the fact that higher interest rates are pulling down buyer demand, and in turn, homes are sitting on the market a little bit longer. You're going to see here in a moment that new listings really aren't coming to the market, and overall sluggish market. But that said, this chart just kind of shows you where we are, year-wise. Goes back, gives you a really good indication, kind of shows you where the peaks are each year. Typically, we would have already had a peak. This week's going to show you we still got a little bit of increase in inventory, both here locally as well as nationwide. So Orange County sitting at 2466. Probably one of the higher numbers we've seen all year, Josh, with regards to inventory. Just more homes on the market, more homes not moving. This is time of the year where we would start to see these numbers decline. We have not seen them decline yet. So the next couple of weeks will be interesting on that front. Huntington Beach sitting at 205, a little bit higher than last week, but still higher in a market where we would typically start to see that seasonal decline.
Jeb, for anyone who's new here, what is that number? Is that total? Is that new this week? Total on available inventory on the market?
Yeah. So here in Orange, like when we're talking those numbers, the Orange County, Huntington Beach numbers, those are single families, condos, anything that's active on the market at the moment. So those are, anything that's available to be purchased. Now, if that number looks like 2,400, that seems like a lot. Well, we're a county of 3.3 million people. Going back to a more traditional market, we would have upwards of 7, 8, 9,000 homes on the market any given point in the year. We're considerably below that. So just to kind of give you an idea of where we stand on that front. And then when we talk about that number below, that 566, that's single family homes nationwide, active inventory. So occasionally you'll see a chart like this and it shows 566,000 homes available. But then you'll see a chart from, say, the National Association of Realtors that shows 1.1 million homes available. And why the discrepancy? Well, the discrepancy is National Association of Realtors also throws in pending home sales, homes that are under contract. They also say, hey, even though they're under contract, they're technically still available. Therefore, it's active inventory. Whereas this just takes active single family homes that are on the market. So, but all of those years are using the same data so you can get an idea, month over month, year over year where you stand. This goes back again to about where we were prior to the pandemic, where we were at the lows and kind of where we are now. This again is about the time we'll start to see that decline in seasonality, but higher rates are likely going to keep it there longer than it should be. This is a chart showing months of supply. So we often talk in numbers. We said 566,000. What does that actually mean for most people out there? It means nothing, but months of supply typically, trigger something with most people because they say, well, 6 months of inventory is a buyer's market or whatever. Well, nationwide at the moment, according to the National Association of Realtors, now you have to remember how they calculate inventory. They're throwing pendings, actives, all of that together. But with that said, we're sitting at about 3.5 months of supply. So supply is grown from the bottom, but still well below where we would be in a normal market. This shows new listings coming to the market. And this is the chart that I talked about earlier. So, when you start to see a market change, when you start to see foreclosures hit the market, when you start to see the Airbnb bust hit the market and all of these properties flooding in the market, this is the chart that you're going to see it on first because this is new listings coming to the market. Well, you're seeing exactly the opposite. You're seeing active new listings coming to the market actually decline. So no new listings coming to the market. The reason inventory is growing because homes that are on the market just aren't going under contract. And that is, because of rates, because of affordability, because of all the things we talk about here. The week over week change went from 562 to 566. So just over 4,000 homes. But here's interesting. So last week, same week last year, rather, we started to see that decline. We went from 578 to 574, Josh. So are we close to that number? Possibly. It's hard to say at this point. We need a couple of weeks doing the same thing to really get any confirmation on that front.
We had a more pronounced spike this year than last year in interest rates, and it lasted longer than it did last year. So I think it would be reasonable to expect that you're going to see a little bit more lag in that slowdown and inventory backup. It's going to be interesting. We're going to learn a lot about the market here over the last couple of months of the year and how that chart looks, how that bar goes throughout the rest of the year.
But again, context, active listings back in 2015, we're sitting at 1,140,000. So we're halfway to that point at the moment where we currently sit just below half. This shows weekly new listings plus immediate sales. Just kind of shows where we are versus where we were last year. You can kind of see how it's drawn on the chart right there. It says 62,000 new listings with 9,000 immediate sales, basically the same as last year. So right now we're more or less sitting where we were the same time last year. Similar market as to this time of year as it was last year. Spike in rates, slowdown in buyer demand, but things turned as rates started to come down. The question is, are you going to see it this year? So weekly new contracts pending. Again, we're still seeing that decline, right? What does this say? 51,000 new contracts pending, basically the same as last year. And then sales are no longer fewer than last year. So we've got a little bit more sales than we did this time last year, which is interesting just based on the current market that we're in. Now, this is a chart that I find some value in the fact that, even though we've had this spike in rates, even though properties are sitting on the market longer, you've got less sellers out there actually doing price reductions, price cuts, if you will. So currently sitting somewhere around 39% of properties doing price cuts, whereas last year we were at 43%. So more people were cutting last year than this year. Why? Hard to say, right? I mean, are people thinking the market's going to turn? Are people like not real sellers out there? And hey, if I get my price, I'll sell. If I don't, I'm not moving. It's, that's one that just have to
You,
guess for the moment.
you want to hear my theory about
Yeah,
last year
let's
of
hear it.
why that? I think that sellers were overly optimistic. They're coming off 2-3 years where they had
No,
all the
fair.
control, could do anything they want. But at the same time, buyers were overly pessimistic. Rates had just shot up 3% on them in 8-9 months. So buyers were like, I don't even know what the new normal is. And sellers are like, there is no new normal. That's my theory. We have no way
No,
of knowing
and
what
and
the is.
and it a valid one. It's just hard to say, right? I think there's a lot of theories on there at the moment on just different things and why things are doing what they're doing. Unfortunately, it's one of those things. Hindsight will look back and you'll go, "Oh yeah, that's probably why." Percent of properties with price reductions. Again, this is the same chart we were just looking at, just kind of in a different fashion. Just kind of goes back and shows you the other years as well, and just kind of where we were versus those years. So that said, Josh, 10-year treasury, we saw a couple weeks ago hit upwards of 5%, pull back to right now as of today. I think we're under 4.5. Did we close under 4.5?
I
I
shut
think we
all my
did.
yes, we did. It's and I didn't use the 10-year chart. I used the MBS chart. So it's under 450.
All right. So unemployment rates. So we did see unemployment go up a little bit last Friday when the jobs report came out. Now we're sitting at 3.9%. Quits, all of that came in a little bit higher. I believe the number of quits came in a little bit higher than expected. But
We got
employment,
Yeah, we've got fun charts covering all
yeah,
of it. Jeb, the,
yeah.
the one to look at here is that big spike is not actual employment market related. That was COVID. And then it took to the beginning of 2022 to get back to that 2017 to 2019 average. So it's important to note that we were a good bit below it. I think with the bottom we hit was 3.4% unemployment. We're up to about 3.8%, and we're going to break above that line. So let's just look at some of this additional data. So Fed rate hikes, unemployment, and recessions. Gray bars are always recessions, but look at these red arrows. Every time you see a Fed hiking cycle, which is the black or light gray or dark gray bar, shortly thereafter, we see unemployment go up. So people are saying, oh, we're not going to have problems with the economy. The Fed hiked and we still have really low unemployment. Well, when we're looking at this, it is reasonable to expect that we're going to see a spike. There's something different now than we've had previously in terms of demographics, a very large generation in the boomers leaving the market and smaller generation coming in behind them. So we may have a structural change where unemployment is lower going forward, but it is going to spike. Just like we've seen the last 1, 2, 3, 4, 5, 6 times we've had a Fed hiking cycle. You were talking, Jeb, about quits. Quits is a share of total non-farm employment. That green line is kind of what normal looks like going back to 2001. Well, we had during COVID, all the power was with employees. So lots of them quitting, went up much higher. And we are just about now to normal. It will be interesting to see if we stay at that 2.25 kind of long-term range of what is considered normal, or if people stop quitting and are happy to have a job and stay put. I do think, Jeb, this is one of the areas I always be careful when someone talks about a new normal, because of the changes in demographics. We may be in a new normal where employees have more power than they've had in the past. This, Jeb, we're in earnings season. So every time a publicly held company has their earnings, they do a conference call. And this is those calls, the mentions of weak demand. So we keep hearing soft landing, economy's hot, everything's going to be great. Yet what do we have here? More and more references from publicly held companies talking about weak demand. What does that mean? Real inflation adjusted retail sales. Jeb, we keep coming on here and saying, hey, retail sales came out high. Retail sales were stronger than expected. This is adjusted for inflation. We are negative year over year on retail sales. The increase in sales is due to higher prices. Those higher prices are generally input costs being passed along. So it's not that companies are more profitable because they're making more sales. They're just selling more expensive stuff because their costs have risen. Looking at the same thing here, Jeb, gap between stimulus-driven sales and employment. So if you look over the long haul, retail sales, that blue line, has tracked real closely with total non-farm payrolls. Yet we had that big dip and we've been recovering from that. But what we had with the stimulus is retail sales put this big giant gap between the two. Very reasonable to think going forward that we will see retail sales decrease, which is that slowing of the economy that we've talked about. Is it a recession? Only time's going to tell, but definitely expect to see slowing. Wanted to take a look at this, Jeb. I've definitely been noticing on our rate sheets, although we're seeing a really nice improvement in interest rates in the 10-year treasury, we're seeing more improvement in mortgage-backed securities and our actual rate sheets. So that spread right now is down to about 2.91. As recently as September 1, it was like 3.1%. So the treasuries, the actual interest rates in the market have improved, but we're seeing more of that trickle through to mortgages and a little bit improvement. That's still massively above the long-term averages, but better. Jeb, I'm sure you saw this. This was one of the more mind-boggling things. Other than Dave Ramsey, Zillow is rapidly turning themselves into our favorite people to bitch about here. They put out a survey this week saying that it was going to take 15 to 20 years for most buyers to break even on their home purchase. So the key context I want to point out, if you guys saw this, so they're saying here, if you put 3% down, it'll take 16 years to break even on that property in Austin. It doesn't account for a rent payment. Most people don't live rent free. They don't have a sweet cave to post up in. Mom and dad don't want them there forever. So it doesn't in any way account for a rent payment. And if you don't own a home, your rent is largely your biggest expense. So it's just, they got the clicks they wanted. It was a very shocking headline. And when you look at it, I'm going like, that doesn't make any sense whatsoever. Did you see it, Jeb?
I did. I didn't really dive into it because to me, it was kind of like a clickbait type headline. They've been in the news a lot. They got crushed on earnings. They got, or after the National Association of Realtors case got settled, or not settled, but the initial hearing came back or whatever, and they just got murdered in the market. And I think they're just looking for eyeballs at the moment to get people on Zillow. But Zillow is one of those things. They have economists, they have people there. They have a lot of data. I don't know where they get some of the information, but it does get clicks. People do pay attention to it. Like anything else, I would say use it as a tool in your toolbox, but do not rely on them 100% for anything. Right. I mean, the idea that it's going to take you 20 years to recoup with 20% or 13 years to recoup with 20% down, to me seems a bit outlandish. But
if you read the footnotes of how they calculated it, you still wouldn't understand what they calculated or what they're telling you. It tells you kind of some of the assumptions, but it doesn't tell me what break even to what. What do we mean break even? You have to have a housing cost regardless. So to me, it was a little bit silly. But back to the fun stuff. This is the chart of mortgage-backed securities. So from the bottom there, where we looked at, there's a little over 3 weeks ago to the top. That's a 300 basis point improvement. So 0.75% improvement in interest rates. We were just at that 8% level and definitely seeing more like the low sevens, which if you remember, if we go back 3 months, we were all bitching and complaining about low sevens. So this isn't like cause for celebration, like everything's great. It's great relative to where we were with that.
That was the last chart. Yes.
We just have the key yields and then showing what interest rates look like.
Yeah,
so this just shows 449, Jeb. There is where we ended, or at least when I pulled that towards the end of the day. And we're more towards the green end of the spectrum than the red, with lots of support above us to keep them from getting worse. More importantly, Mortgage News Daily is reporting 7.41% today. Freddie Mac as of last week was 7.76. They will come out with this week's data tomorrow, and you'll see that number much lower. So all in all, just everything moving in the right direction.
Yeah, no, I mean, I read an article earlier today. I can't remember if it was the one I sent you or if it was something separately, basically showing that the peak in rates last year was like, it was a year ago to yesterday or to tomorrow. It's like almost a year to the day from where we saw the peak last year. So have we seen the peak? Hard to say. I think the answer is yes, assuming the data doesn't go crazy in the other direction. But there's some caveats there, right? Just because we don't know what the data is going to do, but it looks like it's trending in the right direction. All right, Josh, let's do what people came here to do. And that's hit the thumbs up. If you find any value, guys, hit that thumbs up. Also, if you haven't been to the Educated Homebuyer page, if you will, following us over there. This past week, we covered, what did we cover, Josh? Mortgage, manual underwriting. So if you don't fit within the box of automated underwriting, you perhaps have to get your file manually underwritten. What does that mean? How does that work? What goes into it? That process, we break it down on the episode. So if you listen on Apple, Spotify, check it out. And if you are a YouTuber and you like to watch the videos, look at our pretty faces, you can go over and check that out. But do us a favor and subscribe if you haven't done so already. And if you're listening on audio, and you want those charts that we just mentioned, there is a link in the description of the show notes that'll get you all of those charts so you can take them and alter them and show them to your friends and tell them exactly what we've talked about. And you look like the smartest person in the room. So, or if things go the other way, you might look like the dumbest person in the room at some point in the future, but at least you'll be in the room, right? All right. Josh, here we go. We don't have a lot of questions. The people have spoken. They don't care anymore.
Well, we didn't get the stream set up to the educated homebuyer page tonight, so I think we're missing our smaller portion of the audience. But
page, I don't know how many people actually watch it from that page, but we will. Well, they'll hear it on the audio. Then I'm not sure what happened there.
They won't be able to ask their questions though.
They will not be able to ask their questions unless they come over to this page, which they won't find out until later.
We'll be back next Wednesday to answer their questions.
All right. Let's see here. Let's start with a pretty simple one here. How would we go from, let's move it like this. How would we go about finding a realtor in another state? We're looking to move from Washington State to Reno, Nevada. So a couple different ways. You can do your own research and find your own person by searching online, or you could reach out to me. Actually have 3 awesome real estate agents in Reno that are good friends, know the market very well. I'm happy to make a referral for you. You can actually, I'll just click this little banner here. And if you go to that banner on the bottom, that website on the bottom, that'll get you connected. Just fill out your information and I'll email you back with their contact info and you guys can chat. But typically speaking, you want to get a referral from somebody for the most part, unless you know somebody there directly already. Get a referral. It's the best source always. And then if you like it, you don't like it, you can always compare it to somebody that you do your own research out, but it's a good place to start. And the same can be done for a mortgage person. If you need a mortgage there, that link will also get you in touch with somebody that does loans if you need it anywhere in the US. And if you're here on the West Coast, you'll be speaking with Josh directly. So that should help you out. Makeba. I have a question. I bought earlier this year. My rate is 7.1%. Can I refinance if the rates go down to 5 or 6%? Would it make my payment smaller? So Josh, easy softball throw to you here. If interest rates go down, I have a 7%, they drop to 6%. Does that allow your payment to go down? And can you always refinance if rates go down?
So you're complicating it. You're making multiple questions here.
I am.
But if we go back, our parents and grandparents like to talk about, well, don't refinance unless you can save 2%. Well, remember, if they bought in the 70s or the 80s and they had a $30,000 mortgage, you need to save a lot of money interest rate wise to be able to make it worthwhile. With bigger loans, bigger home purchase prices, it takes much less of a movement to make it make sense. So from that perspective, the rule of thumb we use, take $125,000, divide it by your loan amount. It will tell you how much you need to save in interest rate to make it make sense. So let's say you have a $250,000 loan. We take 125, divide it by 250. Tells us we need to save about 0.5%. Now, on the other side, if you have $1 million loan, we take 125, divide it by 1,000, we only need to save 0.1% in interest. Now, the reality is doing the refinance takes some work, effort, energy on your part. Most people are not willing to do it to move down 0.1%, even with $1 million loan. So there's no magic in that calculation other than people, when they see that, they start going, oh yeah, that's a big enough of a move down in my monthly payment to make it make sense. So it takes a bigger move in interest rate with the smaller loan. So depending on where your number is, will tell you how much you need to save. But if you're at 7.1%, 6.5, 6.25, 6% should make sense. And the bigger the loan is, the smaller of a move that you need. So you can do it multiple times. The key thing that I always tell people that we want to be aware of, don't keep going back to a 30-year loan. Even if you're only 6 or 12 or 18 months into that loan, don't go back and start over at 30 months. Most lenders can do a custom term and match it to how much you have remaining on your current loan. And don't also keep adding fees back on top of your loan. You will actually be going in the wrong direction. Our goal is to continue continue reducing your payment, continue paying it down until we arrive at a freedom point at some point where we can get the darn thing paid off. Now, Jeb, your other question is, can we always refinance? There is no guarantee. If you miss a payment, if you lose your job, the big one that everyone's worried about, if the home value drops, you put 3.5% down and it drops 2%, we probably don't have enough equity to do it on a conventional loan. FHA, VA, and USDA all have refinance options that don't require an appraisal, but I think that covered all the bases of the question there.
No, good stuff. Good stuff. This is always a question we get, Josh. I didn't click on it initially just because it's a difficult question to answer, but I'm going to throw it up there and then we're going to probably go back and ask the same question that we always do. But Sarah asked the question, should I buy now or wait for next year? So what are you waiting on, Sarah? Are you waiting on lower prices? Are you waiting on lower interest rates? Are you waiting on affordability to improve so you can actually buy a house? So there's a lot of questions there with the idea of why are you waiting? I guess, the idea behind most people waiting is that they think there's going to be some sort of improvement in affordability. And the reality is you're likely to see at some point rates come down next year. How much? Hard to say at the moment, but are you going to see a big pullback in prices? In most markets, I don't think the answer is yes. I think that more so than anything else, you'll see house prices kind of move sideways. So for me, I just bought a house. In fact, I closed, my house sold today. So I closed tomorrow on the property that I purchased and I bought in this market. Now, I'm paying a higher rate, paying more money for the house, but why? Why did I do it now versus waiting to next year? Well, if I had waited, chances are that house isn't available that I wanted. Right. So my whole thought is at some point I'm going to be able to refinance and bring that payment down. By how much? I don't know. I mean, I can make the payment as it stands. Even though I don't like the payment, I can do it. So that's kind of why I made the decision I did. But you got to be able to make those decisions for yourself and ultimately, determine what's right for you and your family. Josh, do you know anything about Mr. Cooper being hacked?
No,
and sellers
know.
Not able to close because so the question is, the question is, Mr. Cooper mortgage company hacked. Sellers can't close their sales. Do you have any information on that? So seems like a pretty scary thing if you're selling your house through Mr. Cooper or you're getting a loan through Mr. Cooper, I guess, on the retail side, if that's even an option. So thoughts?
It's irrelevant. So first of all, Mr. Cooper is a large mortgage servicer. Many people make their monthly payments to them. They generally acquire their servicing rights from other originators. Obviously, they do originate some loans and those people are being impacted. I guess the big answer or the big thing to know there is don't go to a giant call center farm that just originates loans for servicing for your loan. But in the big picture, we see stuff every week. Credit card companies, auto companies getting hacked and data getting out there. It's especially problematic when it's a mortgage company because our files are so complete in terms of your identity. So not good, no way to spin it positively. And I know they've sort of locked up their systems as much as possible right now, and that's what's keeping them from closing deals. But it doesn't impact you. It doesn't impact the housing market in any significant way.
Awesome. Good stuff. All right. Seems to be a little freeze on my stream. So, we have all browsers shut down. We're operating on 2 gig fiber optic speed here. Guys, I got nothing more. I got nothing else. If this does not answer, fix the problem, I got nothing. Like that's, we're going to have to go to Starlink next, Josh. We're going to have to buy satellite.
What if we had like $300 a month Starlink service and it was freezing? You would lose your mind. You would go full Winnebago man on our Starlink.
Dude, hey guys, listen, this is in all reality. If you have never watched Winnebago Man on YouTube, do yourself a favor. And once this show's open tonight, go watch like 5 minutes. I mean, you're 5 minutes is enough you're either going to love it or you're going to hate it. And it's vulgar, but it's absolutely hilarious. So just, anyway. So when he said go full Winnebago Man, once you watch that, you'll get an idea of what we're talking about here. All right, Josh. This is a good question. It says the myth is that home prices will continue to go up, but isn't that assuming that buyers are not constrained by income? Isn't income topped out at this point? So, Josh, we're every Friday, not every Friday, every first Friday, right, we get the jobs report. With that jobs report, we get wage, right? We get wage reporting as well. And so wages are continuing to moderate some, but we're still seeing yearly increases, what, 3%, 3.5%, something like that. Is that
Yeah.
right?
So the big issue is they're not increasing in real terms. They're not
Right.
increasing at the same pace of
Correct.
inflation. So we had some outside gains for a few years, and they're not keeping pace with inflation. What I will say, I don't like to feed into the whole, 1%er have versus have not, this big gap, but there is a gap. I have people that reach out that are incredibly well qualified, that their debt to income ratio is nice and reasonable. And then I have other people that are stretching just to get to that point. And that's not even to talk about, Jeb, the people that never call you, that never call me because they know it's not even reasonable for them. So it is a problem in the economy, in
Mhm.
like the political environment. It makes people unhappy. They do crazy things, left crazy things, right crazy things. People react different ways, but it's not a positive. But in terms of, we say the myth is that it's only a myth if it isn't actually true. It's a belief at this point. Most people believe that there is support under there, and there are a million things. What you probably should do is ask yourself, what would have to be true for that not to be correct, that home prices would come down? What would have to be true for home prices to remain relatively flat or continue going up? Those are the questions that I would ask. I can tell you it's a really different time as a mortgage originator, because I see like two very different types of borrowers. I've got 4, 5, 6 different sets of borrowers right now that buying in the current market is nothing to them. Would they like to buy at a 20% lower price with a 50% lower interest rate? Yeah, they would love that. But this is not a
Yes,
problem
I
for
would
them.
love that.
You would love that too. But you know what I'm saying? Just like you, they're making the decision, hey, I want to own a home and I'm stepping into the market. So it really depends on where you're at, both income wise and not just absolute income. Because if you make $150,000 a year and you live in Los Angeles, you're probably feeling pretty stressed and pinched. If you make $150,000 a year and you're living in Manhattan, Kansas, you're probably going, this is pretty sweet. I got a $250,000 house. I can pay it
Bro,
off
did
in
you
10,
did you
12
just make
years.
up Manhattan, Kansas?
No, bro, it's where Kansas State University is.
Oh, there you go. Look at that. Learn something
See,
here.
see.
Learn something. Yeah, I mean, what needs to improve for affordability to improve more than anything else? Interest rates have a bigger impact than anything you're looking at there. More so than income, more so than house prices. Interest rates dropping by 0.5%, 1%. I think the number that I heard, I think it was on, from Logan, from Housing Wire, was that for every 1% that interest rates go up or down, about 5 million people can either qualify or not qualify, right? So you either lose 5 million or you gain 5 million people 1% in rate. So you say, well, what's going to help the market? That's going to help the market so more so than anything else. But you're getting to a point, to get back to your question, where affordability is stretched, right? Housing affordability is a problem. So can housing prices not go up because housing affordability is strained? No, they can still go up, right? Because continue to pay the prices, and in some cases pay more, and drive those prices up. Now, are you going to see the growth that we saw over the last couple of years? No, you're not. But in order to see house prices come down in any meaningful way, you need more homes on the market and less buyer demand. And right now, you're sitting at such a low point in the market that any jump in buyer demand does not, it affects inventory in such a meaningful way, because there's so little inventory on the market to begin with. So there's a lot going on here, guys, and it's not going to fix itself in 2024. I can tell you that. This is a couple of years out, probably, if not longer than that.
Hey, Jeb, this is really a comment, not a question,
Yep.
but I want to give some context to it. So Shameen was kind enough to step in here and point out to us that rates have already come back up. They're at 7.83%. So we went through the chart earlier in the show. We've shown you what the 10-year Treasury has done. We've shown you what mortgage-backed securities have done.
Yep.
They absolutely have not come back up. They're at the lowest they've been in about 3 months. What you're looking at is the NBA puts out a figure. Tomorrow, Freddie Mac will put out a figure. Freddie Mac does a poll on Monday. They release that information on Thursday. It's out of date when it comes out. We get this question all the time on the show. Where can I go to look and get reasonably accurate, up-to-date interest rates? Go to Mortgage News Daily. They have an index they post it every day. As of yesterday, it was at 7.41. When they post it tomorrow, it's going to be lower than that because rates improved today. Freddie Mac will have a better number than the 776 that they put out last week, but it's already out of date. And it could be better, it could be worse. Usually, whenever we have a nice improvement that gets posted, they do their poll on Monday. On Thursday, they go, hey, rates dropped. And people are calling up, hey, can I get that lower rate? And you're like, actually, Tuesday, Wednesday, Thursday, they shot through the roof and they're much worse right now. So you have to know the sources that you're looking at. You saw information, it's accurate information, but it's out of date information.
Yeah. And again, like anytime you see a rate posted online, that's an average, typically speaking, of, what buyers are getting. Traditionally speaking, the best rates out there are typically lower than a lot of those. Like what Mortgage News Daily posts, what Fannie Mae posts, every time I look at those rates, they're typically higher than what most buyers are actually getting in the market. Now, again, take it with a grain of salt because of how some of these numbers are populated, but don't look at that number and think that's where rates are. Have a conversation with a professional and actually get your rate, right? Versus because you don't know what goes into that number. You don't know how it was calculated. You don't know when that number's from, right? Because we know that Freddie Mac numbers are a week old, right? So if they're looking at last week, that's a hell of a lot different than rates this week. So just keep that in mind. But Shameen, appreciate you being here. Christina is in the house. So Christina is is the bomb, if you will. So Christina, thank you. Appreciate the comment and appreciate you being here. If you guys don't know Christina, go check out her channel. A lot of value there on the real estate front, and really good person in general. So that said, got Chris saying that real estate mindset has taken multiple shots at me in his recent video. I don't even know who that is. That's fantastic.
Who is he?
Even the best part is when somebody's
you?
taking shots at you and you have no idea who they are. That's fantastic. I guess the fact that somebody's talking about me is a good thing. So, hey, appreciate it. Tell him thanks, or her. I don't even know. Is it a girl? It's a guy. Either way, I'm thankful for that. All right, it's Thanksgiving time. You got to be thankful for things, guys. Be grateful.
I don't know them, Jeb, and I'm taking shots at them that they had to go and just copy Minority Mindset's name. They couldn't even come up with an original name.
Oh, yeah, and actually find value in his channel, by the way.
Yeah.
Let's see here. So, this is for Curson. It says, getting an inspection on my home. What should I expect to hear from my personal inspection after he does his check? So, expect to hear that there's issues. And I'm not being facetious in that statement. I really mean that. So, you're paying an inspector to find a problem. And what I can tell you in 20 years of dealing with real estate is that an inspector, whether it's new construction, I've bought new construction myself, and or a home that's been there 10 years, 20 years, 50 years, an inspector is going to find problems. Now, it can be a number of different things. It can be cosmetic things that need to be addressed, like cracks in the concrete, that sort of thing that aren't really serious issues. It can be code changes over time. Code change might be the way that the stair railing is, right? That, regards to how wide those railings needed to be. Now it's 4 inches. Can't be wider than 4 inches because somebody can stick their head through it, right? So things change over time. So what happens is it's an inspector's job to know code changes and point them out, to also be able to visually look at stuff. But they're also going to check things like electrical, things like plumbing, things like the water heater, the air conditioning, heating, everything, the roof. Just more or less check the property, everything that they can get to without breaking walls. And you're going to hear problems. Now, the question is, are you okay with the problems, or are they real problems that need to be addressed? Like, the house is sinking into the ground, a foundation issue, that sort of thing. Now, I can tell you in as much time as I've done this, rarely ever have I seen a major issue in property. I would say most things are correctable. Most things are addressable. Most things are minor. But they're required to put them in there. Health and safety items, they show up in the report. And a lot of times those are in red, right? Kind of alarming. But at the end of the day, expect to find issues, but you should go into that with that in mind and knowing that probably most of it isn't a problem, but you got to figure out your line in the sand, what you're comfortable with versus what you're not. And then that's an opportunity for you to negotiate with the seller through your agent and hopefully, come up with a credit or get things fixed or what have you. So, but we just did an episode on that, by the way, Josh, where we talked about home inspection versus appraisal inspection. We did that on the podcast channel. So if you go over to YouTube, The Educated Homebuyer, you can check out that video. I think it's last week, or you can listen to it on Apple or Spotify if you don't want to look at our faces. Which
if you can't find it, the link to the podcast is in the link to that episode of the podcast is in the comments. I just posted it for you.
All right, there you go. Awesome. Let's see here, Josh.
Jeb, kind of along the same note. Let's just stick with the same theme here. Yep. Country Strong. Of course, I had it. Where did it go? I'm dealing with difficult sellers. What can I do? They continue to want more time after closing, and that's costing me money. So Country Strong, I think you're still here. Why don't you tell us, well, they want more time after closing? They're saying they're not going to move out. They want to rent back. What is the issue there?
Yeah, let us know exactly what is going on there. And there was a huge infestation of wasp, they said. So seems like a lot going on there. All right. Christina says that she loves when people talk about her. She likes to invite them on the live stream. See, I don't like to invite people on live streams because most of them are idiots. In fact, 99% of them are. They don't understand the data. They don't know what's going on. They just have their belief because, it's they can't afford to buy a house. Therefore, it has to go lower. It's ridiculous. There's channels out there, as we both know, that have been preaching this for years, and they've been wrong for years, but yet people still continue to follow them. For what reason? I have no idea.
Jeb, you and I escaped noticing this, but Dina pointed out to Christina, or hope you enjoyed your birthday weekend. So apparently Christina had a birthday and celebrated without us.
And an entire weekend at that. I mean, that seems pretty short because my wife likes to do a month. So
I believe your wife had 6 different 40th birthday outings. Is that correct? Was it 6?
Yeah, but 40 hit hard over there. We've determined. Yes, and happy birthday, Christina. So anyway, that's another conversation for another day. All right. Well, I don't know here. Josh, really simple one. Probably the easiest question I'm going to throw your way all night. Is there a chance we get back to 6% on a 30-year fix before the end of the year?
Well, literally, I priced a loan out yesterday and we put it in at like 100. So 100 means we would get no rebate. So you're going to have to pay for that. But it was a well-qualified borrower, 20% down, 800 credit scores, and it came back at 6.99%. So you'd have to pay your loan originator. You're not getting a 0-point loan at that, but it's a little bit better today. So maybe there would be a little bit of a credit to offset that. We're not far from the very high end of 6.9 of the sixes for very well-qualified borrowers. So is it reasonable by the end of the year? Yeah. So Jeb, why don't you talk about, just because our friend Kyle in Pennsylvania is here and he hates when people talk about what might happen with interest rates going forward. But we've looked at it, we've charted it out. What is reasonable? What would be our best case? Not we're predicting that it's going to happen, but what would be our best case between here and the end of the year in terms of rate improvement?
Well, I don't know. I mean, that's a difficult question to answer. But what I would say is that I think hitting 4.25 on the 10-year is reasonable within the next couple of weeks, quite frankly. And if you go with the current spread that you had earlier at 2.9, let's just call it 3%. What's 4.25 plus 3%. I mean, you're at 7.25. So that's on the high side, I think, of where you're going to be. Low side, I don't know, man. I called 6% a while ago by the end of the year, and then I kind of went back on it just because I was like, this has gone too crazy. I think the data has to continue to get much worse. And I don't know if there's enough weeks in the year for the data to show up consistently poor enough to get us, to get too much lower. I don't know. I don't know. I don't know that spread's going to change much. Right, we're sitting at 2.9%. Is that gonna drop to 2%? No, I don't think so. So say best case it gets to 2.7, 2.8, somewhere in there. You need a 3.5 handle or something on the 10-year to be able to get down to 6. Is that reasonable? I don't know. I
It's
truly don't.
it's possible, but not likely because we
No,
really.
I don't think it's
My
likely.
wife, Jeb, my wife told me this morning. She goes, "There's only 56 days left in the year."
Right.
So in 56 days, what do we have there? We've got 40 trading days for the bond market to move. That's a lot of movement in a short period of time. And what you said is dead on, Jeb. Can it happen? Yes. What would it require? It would require really negative news for the economy. So unless something took a really deep dive for the worse, when all of the November data comes out in December, highly unlikely. I think we're going to get more of the same. And after 3 months or so of this, so when we get into January and we're seeing more of this, not terrible data, but not good data, then you're likely to see it continue trending that way. Now, the other thing could be possible if things heat up, oil prices continue to go up. You see some things trickle through to inflation. We get strong fourth quarter numbers above and beyond where they think we could be back at 8%. If I'm a betting man, I think we're more likely to see them continue trending lower. And I think we'll see that spread continue to narrow. But I think you're also right there that it's not going to 2% anytime soon. If we got from 2.9 to 2.7 between now and the end of the year, that would be a great thing for the market. And if we went to 4% or 4.25%, a great thing for the mortgage market. So high sixes, can it happen by the end of the year? Absolutely. Am I predicting it, calling for it, expecting it? No, but I could definitely see a path to it.
Yeah, the grind, like we've talked about, it, slow grind lower, right? Rates are probably going to be somewhere between 6.5%, 7.5% by the end of the year, is my guess. Do they shoot up to 8 again? Again, without really poor or really strong economic data, I don't think that's the case. And we're kind of going into that time of the year where you would typically see the economy kind of slow on some fronts anyway. So is it built into the market? Probably, but you're not going to see anything meaningful for a while, and unless something crazy happens. Josh, how would you go about refinancing out of seller financing in a few years from now once equity is built? So say I'm able to find a seller and get seller financing. I get a hard money loan for that matter, right? How do I get out of that financing? Is it the same as a typical refinance, or is there something different?
There's a myth that somehow seller financing is different. When you're refinancing, all you are doing is getting a new loan to pay off the existing financing. It doesn't matter if the existing financing is seller financing. It doesn't matter if it's an FHA loan, a conventional loan, a VA loan. It doesn't matter if it's a reverse mortgage. Some people think you can't pay off a reverse mortgage. There's a lien, an encumbrance on the property. You are getting a new one to pay it off. So the only thing that could or possibly would impact you is, let's say the seller says, yeah, I'm willing to carry it back. I'm willing to give you 6% because I know, or I believe that rates might go lower. I don't want you to refinance. They may say, I'll give you the 6% rate, but I want a 5-year prepayment penalty on it. If you had a prepayment penalty, would be the only thing in there that would dissuade you or make it less likely for you to refinance. But otherwise, seller financing is no different than any other lien. But other than calling up Mr. Cooper and saying, hey, I need a payoff demand for my loan, you're going to call up Mr. Jones, who made your loan, and say, hey, I need you to figure out how much I owe you and send in a payoff demand to escrow.
All right, good stuff. So Country Strong got back to us, says basically closing was November 24th. Conditions, if they can stay at least 24 more days or no deal. And then it comes back and says, let's see here. And this man will not willing to meet me halfway. I'm saying no 24 more days. I said today, December 1st period, I've paid my earnest money and inspection. We've got signed. What am I going to do when he keeps saying no? I won't leave December 1st. So it's something to take into account now, right? I mean, what was your original negotiation of the contract? Because that's something you should have nailed down prior to putting your earnest money deposit into escrow, right? Or whoever's holding your earnest money deposit. So you typically nail down, hey, this is the date of closing. If you need a rent back, this is the day you have up until, and then you have a signed contract. And once you have the signed contract, you put your money into escrow. Escrow opens, you move forward. Now, once that opens, the seller can come back and say, you know what? Actually, I think I need some more time. Can I do that? And ask you, the buyer and the buyer's agent, and you can say, sure, we'll make it work. It's all good. Rent back. This is what you need to do. Or you could say, no, it won't work. Or there can be some negotiation, right? So I think where you are is in that negotiation stage. So if you were to technically, and again, I'm taking this at what I'm reading here. So if what I'm saying isn't accurate, then obviously my comment's not going to be accurate. But at this point, you have a signed contract. If you go back and say no to them, then in theory, they don't have a leg to stand on. They can't back out of the contract just because they don't agree with you saying no. They're in a binding contract. It's up to you. It's very difficult in most states, especially California, for a seller to get out of a contract once they've signed it. And just because they're trying to get you to do something and you don't agree to it, they don't have a leg to stand on. But the caveat here is that if they do create issues and they don't move out, what are you going to do then? Are you willing to take them to court? Are you willing to file, something to have them removed with the courts? How long is that going to take? So there's other things going on here. Josh, you look at this. If I were the buyer and I had a seller acting like that, I mean, first off, you need to rely on your agent. They're the professional, right? We're just here. We don't really know everything. We don't have all the context. So rely on them. But, if you're already dealing with that now and you have an opportunity to get out and not lose your deposit and stuff, maybe that's the best option so you don't have to deal with this. But not my recommendation. My recommendation is rely on your agent. Josh?
Legally, you have a contract. They don't get to renegotiate or tell you what they're going to do. The contract says, I'm going to pay you this much. We're going to close on this date, and they have to get out. The reality is real estate contracts are a little bit unique. That person is in that house. They could be a massive thorn in your side, and winning that battle, whether it means paying lawyers and going to court or just dealing with this pain in the ass, may not actually be winning. So Jeb covered that pretty well, but it's interesting and unique that you are right and you can win, but winning may be more painful than just letting it go.
Agreed. Yeah. I mean, well said there, Josh. But again, I will go back, rely on your agent, talk to the broker. Like, that's where having a reputable company that has a legal team, that has people you can talk to, that's where that stuff matters, right? Versus going with, somebody that doesn't have that backing. It should be taken into account, when you're deciding who to work with in many ways. Josh, we got a super chat coming in from Mina. Says, I know you guys are not soothsayers. I don't even know what that means.
I take exception. I've told my wife for many, many years, I am a soothsayer.
Okay. Well, maybe you can provide me what the definition of that is, but do you all know historically if mortgage rates trend downwards closer to an election year? So Josh, not something I follow closely. But every 4 years we have an election here in the United States, presidential election. What do rates typically do during an actual election year?
It's not something that I look at all. And Jeb, when I hear this question or questions along these lines, what I relate it back to is everything is a rule until it isn't a rule. And this wouldn't be. It wouldn't be consistent where 20 election cycles in a row rates went up or rates went down. One of the things we talk about, we've seen a lot of people saying, yep, see, that yield curve inversion isn't actually predictive of a recession because we haven't had a recession yet. Well, I wouldn't just look at that. It's been a perfect indicator, and we are still within the window of that being the case. But I'm just using that as a data point and something that is shown to be predictive. I want to line up 4, 5, 6, 7 different data points that are all pointing to that happening. So in terms of expectations for next year's interest rates and what I think is going to happen, that election cycle is the least of my thoughts. The only thing that I think would come into play is it would behoove the incumbent to keep interest rates under control as much as possible. And I don't think anyone running for office that's not an incumbent has much control over interest rates. They might like them to spike up to 9% to make everyone unhappy, the economy to kind of tank, and then therefore they're more likely to win. But they don't have control in any real form until they're in the office. And I will also say that presidents get way too much credit for the good things that happen when they're in the office and way too much credit for the bad things. They don't have nearly as much control as we would like to think that they do. So a long way of saying I don't really have a strong opinion on it one way or the other. But Jeb, just so you know, a soothsayer is a person supposed to be able to foresee the future.
Oh, there you go. I've learned 2 things tonight. I've learned that there's a Manhattan, Kansas, and that a soothsayer is a fortune teller.
And Mina used it perfectly in context.
Even better. I don't even really know where to go from there, Josh. So let's see. We got Mina's question tackled there, and thank you for the super chat, Mina. I Not sure if I did say thank you, but I am grateful for that. Let's see. We had a comment here. That was really not something that we needed to address. Just got it going through some things here, Josh. Any questions? Let's see. Not really a lot out there. People have it all figured out. They don't need us anymore. They
Well,
don't need us
let's
anymore.
continue this conversation then. Country Strong comes back. React to this, Jeb. I agree. I didn't realize my agent was very new. I had to tell her, look, I need your boots on the ground. She's now understanding, and another agent is helping her. We have a contract signed. Just comment on all that. I feel like we're a broken record either here or when I do the Vetted VA Live. Say, you have to work with someone that's knowledgeable and experienced. This is not, I mean, anyone can get a license very quickly and say, hey, I'm a realtor. Hey, I'm a loan officer. But we hear this stuff all the time.
Yeah, it can come up in many different ways, and being a new agent's not a bad thing. Yeah, everybody has to start somewhere. So I will say that working with somebody that has had their license for a longer period of time doesn't necessarily mean they're a good agent either. But one thing I will say is that experience in situations does help a lot of things, just in general, right? So what I could tell you is that an example, my wife was in the hospital a couple weeks ago, and being in the hospital and being around people that, when I ask a question, they had an answer. And I was asking detailed questions, right? Because it was a complicated situation. And so I'm asking questions that I'm guessing is not going to stump anybody, but probably questions that they don't get every day. And so they were able to make me feel at ease by answering my questions. Therefore, I knew I had a professional. Now, had they been somebody new, probably would have been, it would have been more difficult for me to took what they were saying at face value and whatever. Being an agent is completely different, right? Your life's not on the line. There's a lot of leeway in things, but when it comes to negotiating, newer agents, just people in general, not even newer agents, people don't like complicated situations. They don't like to, they don't like conflict. Most people hate having difficult conversations because it's uneasy. I don't enjoy difficult conversations at all. But what I will tell you is that if something goes wrong in any scenario, we have the conversation immediately. It's not, a lot of people will sit there and be hesitant to call the buyer, because the agent, and not want to have it because it's not an easy conversation to have. A good agent is willing to have that conversation so that we can work to get through it, in many ways. And I gave an example a couple of weeks ago about my client, an HOA assessment coming up the day before closing. Seller said they weren't going to pay it. Like, no, you're going to pay it. Like, it's a changing contract. We can back out. And having experience allowed me to have that conversation with confidence. Same thing here. Like Josh said, you have a signed contract. Technically, you are in the driver's seat. Now, unless you got some crazy state law wherever you are that allows the seller to do something different than they would here in California, because I only know the California residential purchase agreement in any detail. In California, you could not do that, right? There's no renegotiation of terms. This is what it is. And if the seller doesn't want to do that, then guess what? There are issues. There are repercussions for not moving out when they're supposed to move out. Now, that's up to your agent to convey to their agent. And if they're not willing to negotiate, the brokers need to get involved. There needs to be a conversation about, this is what's going to happen if this doesn't take place on X day. But if nobody's willing to have that conversation, then the seller might just do whatever they want. And if that's the case, then, you're not getting the representation that you should. And so kind of goes back to what we said earlier. You have to make a decision how far you're willing to take this if the seller doesn't move out when they're supposed to. Are you willing to take them to, in California, you've signed a contract, and most people, agree to mediate, to go through arbitration prior to getting attorneys involved. Okay. So that's something you sign in the contract. So in the case that the seller says no, you have to agree to sit down with a mediator and have a conversation prior to ever going to court, at which point you don't come to a resolution, then it goes to court. So there's a lot that goes on here in the background, and I don't want to scare you about that, but the reality is you are in the right place. You've done what is right by you. The seller just needs to understand their place. And I realized I went a long way down a rabbit hole there, Josh.
Jeb, we got two good questions to close out, one real
Yep.
estate and one mortgage. So you get the real estate one first. Christina, a regular viewer here. How do you find out if you can have livestock at the property you want to buy?
Wow.
Doesn't come up often in Orange County.
No, not here in California. So, there's probably some city code to it. If you're in like a rural area, I don't think there's probably much to say. I think you can just do whatever you want. Like in North Carolina, where I grew up, if you want a cow, you put a cow, you can have one in the front yard if you wanted. I don't think anybody's going to say anything. But even here, like if you're in an association, right? A lot of places are. I know an association here, multi-million-dollar homes on a golf course, they have chickens in the backyard. Like I can hear them when I'm golfing. So I think probably city code for one. If city codes allow it in that area, then if you're in an association, you got to check to make sure your association allows it. Kind of go down that rabbit's hole, if you will. But I think starting at the city level is probably where you want to start. Hey, is this a possibility? And if it is, then you kind of got to go down the rabbit's hole. Outside of that, I honestly don't know the answer to that. This is the first time I've ever been asked that. And, I think it probably depends on the type of livestock we're talking about too. Like here in Huntington Beach, there's an equestrian area. I'm not sure a horse falls into livestock, but it's, something that wouldn't be normal for most areas. In an equestrian area, you can have horses, right? There are stables, there's things there. If I wanted a horse where I live, you can't put a horse in my yard. They're not going to allow that. So, that's all I got.
Before next week's show, Jeb, I want you to research and find out if I can have a goat at my house. Not a big one, a little pygmy goat.
I think you can have a goatee. I mean, you can have a pig, right? A little pig. I was watching Sports Center the other day with Peyton Manning and Eli, and Arnold showed up on the stream, and he had a jacket, like a donkey on, like licking his face in the video, like in his house. There was a donkey in Arnold's house. Jeb,
I mean, I'm gonna one up you. My wife, is involved in the French Bulldog rescue. She picked up a Frenchie, took it out to another rescue that they were going to keep it. And when she got there, this was actually a wildlife rescue. And the lady had a skunk. And she said, "Why is there a skunk here?" She says, "Well, you would find this hard to believe, but millennials think it's really cool to have skunks for pets. But they are not allowed to be kept as pets. So when they find them, then they have to go to court, and then they're told they can't have them. So then they got to take them and release them in the wild." So apparently there are people who think having skunks is cool, but that's different than livestock. So let's go and answer one good question before we get too far down the rabbit hole of livestock and skunks. Eric Trejo says, "My wife and I have similar credit scores. Can we be on the same loan to qualify for the house?" Yes, 100%. Absolutely. You can both be on the loan. And with similar credit scores, that's the most beneficial. If you both have 640 credit scores or you both have 800 credit scores, neither one of you is dragging the other one down. Now, let's assume your wife had the 800 credit score, you had the 640. You can both still be on the loan, but the lender is going to use the lower middle credit score. So whichever one of you is there is going to impact the other. So sometimes if a borrower can qualify without their spouse's income and that spouse has a much lower credit score, we'll leave them off. I have one right now that I have to have that conversation. We have to say, "Hey, you just provided me your updated 2022 tax return. Your wife actually lost money on her Schedule C last year, and she has a 710 credit score. You have a 780. Can we just put her on title to the property and not on the loan?" So a little more detail there, but in your situation, absolutely. With similar credit scores, both of you go on the same loan.
All right. Good stuff, guys. So it is 6:03. If you haven't done so already, do us a favor, hit the thumbs up. Helps the YouTube algorithm push it out to more people like you that are interested in buying, selling real estate, interested in mortgage related questions. And if you haven't, subscribed to the channel, I would be grateful if you do that. We're about 7,000 subs short of 100,000, and it would make my kids' life if I had 100, if they could have a play button, quite frankly. That said, Josh, if you haven't been to the Educated Homebuyer channel, check it out. Rate and review the podcast if you find any value in it at all. Next week's episode, we're actually diving into the idea of buying units. So, with minimal down payment. So if you're interested in that, stay tuned. I'm going to send it out with you tonight, Josh, to say the finale.
Well, you switch it up here. I don't even know which one we're going with. Let's just say this. Thanks for showing up. Buy wise, borrow smart, build wealth. Adios.
Amigos.